Ever hit the buy button on a stock, only to see the actual price you paid be slightly different than what was flashing on your screen? It's a common, and often frustrating, experience for investors, especially when dealing with high-speed markets. You might have been quoted one price, but the price your order executed at, your execution price, was lower or higher. This tiny difference is more than just a minor annoyance, it's a window into the mechanics of how your order actually gets filled. And the gap between the price you see and the price you get, along with the time it takes, boils down to two key concepts: M1 execution prices and delays. Let's dive into what's really happening from the moment you click trade to the moment you own that share. What is an M1 execution price? The term M1 execution price refers to the price at which your brokerage, like M1 Finance, completes your trade. The crucial thing to understand here is that M1 is designed to process trades efficiently, but they don't do it instantly. They use what are often called trading windows. Unlike some brokerages that offer real-time, second-by-second trading, M1 typically has a single trading window each day, usually in the morning. This is a design choice aimed at promoting long-term investing, discouraging day trading, and reducing operational costs, which is one of the reasons they can offer commission-free trading. When you place an order, it doesn't get filled immediately. It gets queued up and held until that specific trading window opens. Once the window is open, M1 bundles all the customer buy and sell orders together and sends them to a market maker or an exchange to be filled. The M1 execution price is the average or current market price that exists at the exact moment your aggregated order is filled. The role of market volatility and delays. This is where the concept of delays becomes important. There are two types of delay at play. First, there's the pre-planned delay from the trading window itself. If you place a trade at noon, and the window is at 10 a.m., you're waiting 22 hours for your trade to be executed. Second, there's the execution delay, which happens even within the trading window. The market is not a static place. Thousands of trades are happening every second. While your order is in transit to the market maker and being processed, the stock price is constantly fluctuating. This phenomenon is known as price volatility. If a stock is moving quickly, the price that was displayed when the trading window opened might be different, even a few cents different, by the time your order is actually processed and filled. This tiny fluctuation is the difference between the quoted price and your execution price. What does this mean for you? For most long-term investors, a few cents difference in the execution price isn't a huge deal. If you're buying a stock for a retirement account that you plan to hold for 10 years, a 5 cents variation today is negligible in the grand scheme of things. However, if you are attempting to buy during a period of extreme market volatility, like a major news event or a market crash, the price movement during that window can be more pronounced. You need to accept that by using a platform with limited trading windows, you are prioritizing convenience and lower cost over price certainty. You are essentially agreeing to accept the price that exists when the trade is executed, not the price you saw when you clicked the button. Understanding M1's execution process, that your trade is bundled and filled during a specific window at the then current market price, is key to managing your expectations and not being surprised by a slight difference in your execution price. With that said, thanks for watching, and until next time.